Welcome to LR Reports. This episode is based on institutional research published by a leading global financial firm. We focus on the core investment thesis, key assumptions, and material risks outlined in the original report.
Okay, let's unpack this. We are jumping right into the financial expectations for US equities as we turn the corner toward 2026. This deep dive really hinges on one central idea, that the market is finally transitioning from a highly concentrated rally to one with genuine, broad-based momentum.
And before we get into the substance, let's just formally set the context here. Our analysis today is based on the Deutsche Bank Research US Equity Strategy Report. It's titled 2026 US Equities Outlook, Staying Constructive, and it was published on November 25, 2025.
And our mission today is crucial. We're going to be rigorously analyzing this constructive thesis from Deutsche Bank.
Wow.
They're looking for mid-teens returns, which, that ultimately translates into a year-end 2026 S&P 500 target of 8,000. That's a very bold number. We need to understand exactly how they justify it. So what's the foundation? What's the rationale for staying constructive?
The foundation, well, it requires acknowledging the immediate past. The preceding three-year bull market has been intensely two-speed. Yeah, think of it like a marathon where only a handful of runners are actually sprinting.
Yeah.
We saw these massive earnings and stock price gains concentrated almost exclusively in mega cap growth, or MCG, and the broader tech sector.
And MCG, just for clarity for our listener, that refers to those massive influential technology and growth stocks, often called the Magnificent Seven, or similar groups that have really dominated the indices.
Exactly. And while those giants were powering the headline S&P 500 returns, the rest of the market, the vast majority of companies, remained comparatively anemic. Their earnings growth outside of those tech titans was very closely tied to the U.S. manufacturing sector. And that sector, over the past 3 years, has been in a severe duration-weighted contraction.
Duration-weighted contraction.
Yeah.
That's a slightly jargon-heavy term. Could you maybe simplify what that really means for the typical S&P 500 company?
Sure. It just means the slump lasted a long, long time. It wasn't a shallow quick dip. It was a sustained period of weakness in factory orders, in industrial output. And this created that two-speed dynamic. Secular growth in tech was fantastic, but cyclical growth pretty much everywhere else was flat or even shrinking. This concentration, of course, it leads to concerns about bubbles and sustainability.
And this is where the narrative shifts, right? This is where Deutsche Bank finds its confidence. The latest earnings data seems to suggest this two-speed market is finally merging into one lane. What did the Q3 2025 earnings season reveal that was so critical?
Q3 provided the critical empirical evidence for that broadening strength. Overall, S&P 500 earnings growth surged to 14%.
Wow.
That's a great headline number, but the essential insight is where that growth came from. 2/3 of that acceleration came from outside MCG and tech.
That is the real inflection point, isn't it? The engine isn't just one giant cylinder anymore.
It's the whole block turning over. The growth for the typical, the median company in the index surged to 11% in Q3. That's up significantly, having been kind of stuck in the 7% range for the preceding 2 years. And the number of sectors reporting positive year-over-year earnings growth jumped dramatically from just 2 to 6. This signals that the cyclical recovery is finally gaining traction.
So the thesis is the market is broadening, which provides a much more resilient support than a concentrated rally. If that's the key ingredient, what's the resulting earnings forecast for 2026 that gets us to S&P 8,000?
So Deutsche Bank forecasts S&P 500 earnings per share, or EPS, of $320 for 2026. This translates to a really robust 14% growth rate, which is an acceleration from the estimated 10% growth in 2025. And critically, this 14% forecast is above the historical non-recession median growth rate, which is about 11%. This acceleration and this broadening of earnings, they argue, is the primary engine driving that S&P 8,000 target.
Okay, that brings us directly to the elephant in the room, valuation. We're talking about projecting mid-teens returns on top of a market that is already trading at.
Well, at what many would consider historically elevated levels. The report acknowledges the S&P 500 trailing multiple is running around 25 times earnings. That is well above the historical long-run average of, 15.3 times.
15.3, yes.
So if I'm a skeptical investor, I look at that gap 25 versus 15.3, and my immediate reaction is bubble. How does Deutsche Bank justify that current level, let alone argue that multiples are warranted to sustain or even push higher?
And that skepticism is warranted. The report really does tackle it head on. They argue that comparing today's 25x multiple to the 15.3x historical average is fundamentally flawed because the structural drivers of valuation have shifted profoundly over the last few decades. The modern market just operates under different financial rules.
That's a huge claim. What are the mechanics behind these new rules? Give us the 4 structural drivers they cite to explain why 25x might be the new normal. Okay, so the first factor is payout ratios. Payout ratios, that's the total amount of earnings companies return to shareholders through dividends and net buybacks, have been consistently running between 70% and 80% over the last decade. Historically, that norm was much, much lower, closer to 50% to 60%.
Why does returning more cash to me as a shareholder lead to a higher multiple on the stock?
Because it means each dollar of earnings is inherently more valuable to you. When a company retains earnings, you're betting on their ability to reinvest that cash at a higher rate than you could get elsewhere. When a company returns the cash directly, the earnings are more liquid, more certain. Deutsche Bank calculates that this shift alone, from 50% payout ratios to 70-80% theoretically, results in something like a 35% to 40% multiple lift. It structurally changes the market's pricing.
So you're not just buying a dollar of earnings, you're buying a more disciplined, shareholder-friendly dollar of earnings, which should naturally command a premium. Okay, that makes sense. What's the second structural factor?
The second is perceived trend growth. The rolling 10-year trend rate for S&P 500 EPS growth is currently running at about 9.5%.
Right.
And that figure is markedly above the long-run 90-year trend rate of 6.5%. Higher perceived long-run earnings growth is probably the most powerful justification for higher multiples. The market is pricing in structural acceleration, not deceleration.
And the third factor addresses the macro environment, specifically inflation.
Yes, the third factor is inflation. Inflation returning to the 2% target puts it well below the historical long-run average of 3.1%. In finance, lower inflation reduces the expected return, or the hurdle rate, required by investors to put money into risk assets.
Let me just translate that for the listener. If inflation is low, my savings aren't getting eroded as fast, my bonds aren't paying me very much, so I'm willing to pay a much higher price, a higher multiple, for reliable equity earnings because the alternatives are simply less attractive.
Precisely. You're willing to accept a smaller yield or a higher price for the same stream of earnings because that benchmark risk-free rate is lower. The final factor they point to is earnings resilience. The report highlights that the frequency of large earnings declines, so 10% or greater drops, has fallen significantly over the last 3 decades compared to the pre-1980s period. Increased reliability and stability of corporate earnings, well, it increases their perceived quality, which again justifies a higher price tag.
That's a pretty compelling array of 4 structural shifts that make the case that 25x is sustainable, maybe even cheap, compared to the market of 30 years ago. Now, zooming in on that mega-cap sector, there are massive capital expenditure concerns, this huge spending spree on AI, on data centers. Is that spending a bubble indicator, or is it a sign of health?
Deutsche Bank views it as health, and while tech capital expenditure is at the top of its historical trend, the crucial comparison is not the raw dollar amount, it's CapEx as a share of EBITDA.
Why is EBITDA the right metric here?
Well, earnings before interest, taxes, depreciation, and amortization EBITDA is a good proxy for the cash flow a company generates from its core operations. So, comparing CapEx to EBITDA shows how much of a company's operating cash flow it's plowing back into investment. Currently, that ratio is running around 40%. The report points out that this is still well below the sustained levels we saw during the second half of the 1990s, where that ratio ran consistently at 50%.
So if they were spending 50 cents of every dollar of operating cash flow back in the late 90s, and they're only spending 40 cents today, the implication is that this secular trend still has plenty of room to run up further. It reframes the entire tech CapEx discussion from a warning to maybe a mid-cycle indicator.
That is exactly the takeaway.
Okay, given that constructive macro and valuation picture, let's get specific on portfolio strategy. What are Deutsche Bank's high-conviction sector calls for 2026? How do they tie back to that broadening earnings thesis?
The overweight calls, they focus heavily on sectors where unpriced cyclical recoveries are set to converge with favorable secular or policy tailwinds.
Let's start with financials. They've been mixed performers lately.
Right. Financials are overweight due to converging and, importantly, unpriced tailwinds. Specifically, they anticipate a pickup in loan growth, a substantial recovery in capital markets issuance, and renewed M&A deal flow. The market, they believe, is still pricing in lingering recessionary fears that just haven't materialized.
And what about industrials, the sector that was most hurt by that long manufacturing slump you mentioned earlier?
Industrials are overweight for a dual benefit that plays directly into the broadening thesis. On one hand, they benefit from powerful secular growth drivers like infrastructure spending, defense contracts, data center build-outs. But more importantly, they provide a cheap option on the anticipated cyclical pickup in manufacturing that Q3 earnings hinted at.
And healthcare.
Healthcare is overweight on the view that the noise, all the post-pandemic hangovers and political policy headwinds is now fully, or even more than fully, priced in. They see earnings growth outside of managed care beginning a strong recovery.
Okay, so where are they positioned more neutrally?
Well, MCG and tech are neutral, not overweight, despite the intact long-term uptrend. The report notes that recent performance has run ahead of itself, and while growth remains strong, it's expected to moderate back toward the mid-teens range in 2026. Still fantastic, but closer to trend.
And consumer cyclicals. They're so vital for the broader economy.
Neutral here, and it's a conditional call. The issue isn't demand. Consumer spending is still robust. The issue is margins. Consumer prices are too high relative to labor costs, and that squeezes profitability. They need to see significant corporate cost restructuring efforts to close that gap before an upgrade is warranted. Materials are also neutral, needing a clearer cyclical pickup or a US dollar down cycle as a catalyst.
And finally, the areas to underweight, the defensives.
The stance is a clear underweight on bond-like defensives, so telecom, REITs, and consumer staples. This is driven by the ongoing risk of rising bond yields, which could be driven by this economic acceleration we're talking about. Plus, consumer staples margins remain weak despite high product prices. Utilities are a key exception, though. They're neutral because the surging power demand, often driven by data centers, provides a powerful offset to that rising rate risk.
Let's pivot to risks. Even with an S&P 8,000 target, what are the primary downside risks that they've flagged?
The primary risk remains growth disappointment, specifically the resilience of the labor market. Even though earnings are broadening, the underlying labor market dynamics show stress points. The gross hiring rate is currently recession-like, not far above GFC lows, and layoffs, while localized, are increasing. Corporate cost-cutting is still an acute focus, which means earnings growth is heavily reliant on margin expansion, not just top-line revenue growth.
They seem to anticipate strong Q4 2025 results, though, despite what consensus is expecting.
They do. The current consensus implies a sharp negative sequential decline in earnings for Q4. The report views that as highly likely to lead to upgrades or big beats. On policy shifts, the report expects checks and balances ahead of midterm elections to temper any major shocks. And as for tariffs, they estimate the direct impact, a modest 2% rise in core goods prices, has largely already happened.
Okay, finally, let's look at the plumbing of the market, the demand and supply dynamics that are supporting that 8,000 target.
The demand-supply framework is supportive, mainly because of favorable positioning. First, there's positioning upside. Consolidated equity positioning is neutral, sitting at the 39th percentile historically. But crucially, they highlight a disconnect. Discretionary investors, the active managers, are notably underweight equities. They're implicitly pricing in negative earnings growth if they re-engage. Well, that represents a massive source of potential market upside.
So the skeptics are basically sitting on a massive pile of dry powder, just waiting to be convinced by this broadening earnings trend.
Precisely. Second, cross-asset inflows are expected to continue benefiting equities. Households built up massive cash holdings during the pandemic, trillions above trend, and a lot of new savings is now flowing into financial assets. And third, buybacks. They're expected to be robust, totaling an estimated $1.4 trillion gross in 2026, which is consistent with strong earnings growth.
And on interest rate sensitivity, what is the key finding there regarding rates and equity returns?
It reiterates a key finding. Equity returns are primarily driven by the volatility of rates, not their absolute level. They track this using the MOVE index, which is basically the bond market's VIX. As rate volatility falls, the market is historically supported. It reinforces this idea that stability is more important than the absolute height of the 10-year yield.
So what does this all mean for you? Deutsche Bank's Constructive Outlook relies on three primary pillars to get us to S&P 8,000. First, the continued resilience and broadening of earnings beyond the tech giants. Second, favorable long-term structural factors that permanently justify these elevated valuations compared to history. And third, supportive market flows driven by currently neutral investor positioning and high household cash levels. It's a thesis built on momentum spreading throughout the entire index.
And if we connect this all back to the structural insights, specifically that tech CapEx discussion, that CapEx as a share of EBITDA is still running well below the late 1990s levels, it raises an important reflection point for you, the listener. The difference dictates the long-term sustainability. Does this current secular growth cycle feel more like 1995, that slow, steady inflection higher, where productivity gains really started to embed in the economy? Or does the rapid price appreciation put us closer to 1999, the peak speculative phase where investment just outran cash flow?
A fascinating distinction, and it's dependent entirely on how long this CapEx boom can realistically run. This deep dive was purely an analytical distillation of the provided institutional research report 2026 US Equities Outlook. Staying constructive.
You have been listening to LR Reports. This content is for informational purposes only and does not constitute investment advice.